So today I'm going to be going over some of the trading metrics that you might see when you're running a backtest or a strategy analyzer on a specific strategy that you're building or an algorithm that you're building. So our example metrics for this are going to be a net profit of 5,000, a 2.0 profit factor, a 50% win rate, a $50 average trade, and a $2,500 max drawdown with 100 total trades. Onto our metrics. So your total net profit, this is the big one, right? This is the big one that you see every time that you run a backtest or a strategy analyzer, whatever you're running. So this is how much money your strategy actually made, but it doesn't tell the full story, and that's why you need to relate in all the rest of these metrics. So your total net profit is just the dollar result of every trade added together. So it's your gross profit minus your gross loss. In our example, it's 10,000 minus 5,000 equals our $5,000 in net profit. Our gross profit is the sum of all winning trades in the data set, excluding any losing trades. So 50 winners times 200 equals our $10,000 in gross profit. Our gross loss is just the inverse of that, which is the sum of all your losing trades in the data set. Now your commissions, this is the broker's cut for executing your trades, and you'll take these on both sides. So for example, when you enter the trade, you would take $1.75, and when you exit the trade, you would take $1.75 in commissions, and that goes straight to the broker, and that erodes your edge. So my example there would be for like one mini NQ. On smaller contracts, on a micro, they'll be lower, and on different contracts, they'll be higher, but that erodes your edge. The nice part is that most backtesting softwares will model that in for you, and you can select it to be modeled in. But if you can't, then you need to take that into account because it is going to erode your edge, as well as the total fees, which is the exchange and data platform fees that are separate from the broker's commissions. Now, the problem with these is that most backtesting softwares won't model in fees, so you need to take those into account because they will also erode your edge. Your profit per month, this is just the total net profit divided by the months traded. This smooths out the bad months and the good months and averages what the strategy made per month during the backtest period. Onto your risk-adjusted returns. So your max drawdown, this is your biggest peak to valley in your equity curve. So if you see that chart that I have on the side of it there, so you see the biggest dip is our max drawdown. And you always want to compare it to your net profit. In our example, we have $2,500 in drawdown and $5,000 in net profit, making it a 2-to-1 relationship. Now your profit factor, this is every dollar won for every dollar lost. It's calculated as gross profit divided by gross loss equals your profit factor. In our example, it is $10,000 in profit divided by our $5,000 in losses, gives us 2.0 profit factor. Anything below 1.0 is a losing strategy because every dollar that you win, you're losing more than a dollar. And then between 1 and 1.3, that's starting to get fragile. You want to try and optimize some more. It's not something that you totally need to write off, but it is, you need to take that into account. It is a fragile system. Between 1.3 and 1.6 is solid. So that's kind of the sweet spot. That's where most strategies that are profitable are going to sit. 1.6 to 2.0, that's very strong. You're onto something good. You're onto a very good strategy. And then above 2.0 is very great. I mean, if it's not a curve fit 2.0, that's fantastic. But you need to make sure that you're not curve fitting to get there. And I'll make another video on curve fitting. Now your Sharpe ratio, this is the returns earned per unit of total volatility. So it's your average return minus the risk-free rate divided by the standard deviation returns. So the higher the Sharpe ratio, the smoother your returns are, but it also penalizes you for upside volatility, which is good for trading, not just the downside volatility. Because all the upside volatility, you're making money, which relates us into the Sortino ratio. So the Sortino ratio is like the Sharpe ratio, but it doesn't punish you for upside volatility, which is more fair for trading, as upside volatility is making you money, whereas downside volatility is what's losing you money. So when you compare the two together and your Sortino is significantly higher than your Sharpe, then you know that most of your volatility is concentrated to the upside, which is good for you. Now onto the Ulcer Index. This is a measure of how deep and how long the drawdown periods are. So you want to think of it as like stress of holding the strategy. Two strategies can have the same max drawdown, but different Ulcer indexes. So the higher the Ulcer index, the more antacid you would need to hold through the drawdown periods and the more pain you might feel. So you need to be prepared for that, and that's what that's telling you. Your R squared is your equity curve following a straight line upwards. So it's a score between 0 and 1, with 1.0 being completely linear. You see in the little graph that I have there, we have one linear line, and then we have what our actual equity curve might be, which is kind of going up and up, above the line, below the line, above, below, like that. So 1 is completely straight, 0 is terrible, and then anything in between is just how choppy your equity curve is. Your max time to recover, this is just the longest stretch between a peak and a trough. So when you go up, you come down, and then by the time you come back up to a new higher peak, what's the total max amount of time it took to get there over the backtest period? And then your longest flat period is just the longest stretch the strategy's equity curve stayed flat and you didn't make any money. Onto the trading statistics. So your total number of trades, this is just all the trades that the strategy took. So in our example, it's 100 total trades. This is our credibility multiplier for all of our other statistics. Between 1 and 100 trades, it's basically meaningless. There's so much room for randomness in there. And then between 100 and 400, that's when it starts to mean something. You can start to trust the data. And then above about 400 and onwards, you can really start to trust the data and believe what it's telling you. And then as you go up from 400, you can trust it more and more and more. On to the percent profitable, or your win rate. This is just the share of trades that made money. So in our example, it's 50%, 50 out of 100. This metric by itself is meaningless because a strategy can have a 90% win rate and still lose money, or a strategy can have a 25% win rate and make tons of money. So you need to take it with some nuance. On to the average winning trade. This is just the average dollars made on a winner. If your TPs are fixed, it'll be just your TP value. But if you're using variable targets, then it's a meaningful metric. On to our average losing trade. This is just the inverse of the winning metric. It'll be your stop loss if you're using fixed stop losses and take profits, and it will be moving, and you'll have an average of it if you're using variable targets. So your ratio average of wins and losses, or your payoff ratio, is how big the average winner is versus the average loser. So the average winner divided by the average loser. In our example, 200 divided by 100 is 2.0, meaning the strategy wins twice as big as its losses. The win rate times the payoff ratio of this is 2.0. If the TP was then lowered to 100 on this strategy, we would still keep our 50% win rate, but our payoff ratio would be 1.0. So 1.0 times the 50, we would be completely break even on the strategy. Your average trade, this is the average profit of a single trade, or your dollar expectancy. So it's net profit divided by total trades. It's $50 in our example. The long way confirms this. So 50% times 200 minus 50% minus 100 equals 50. 50 times 100 equals our 5,000 in net profit. Your max consecutive winners or losers, this is just the longest streak of winners or losers in your data set. Largest winning and losing trades. So this is the single best and worst trades. If you're using fixed TP system or fixed stop losses in your system, they should align with your take profit and your stop loss. In a variable target strategy, you need to ensure that your returns aren't based off of like one massive winning trade, and that's not totally changing your data set. So if you are using variable TPs and stop losses, you should make sure that your largest winning trade is a modest multiple of your average winning trade. So it's your activity timing and executions. So your average number of trades per day just sets the cadence for your strategy. It's how many trades does your strategy take per day on average. Your average time in the market simply just takes the average holding time in bars, or sorry, in time. The average bars, I was meaning to say, is just, as the name implies, it's how many bars are in the average trade. So you can cross-reference that with the average time in the market, and then you can derive the time frame of the chart that you're trading on. Your total slippage is the difference in expected entry price and realized entry price, often shown as 0 in backtest because they can't model the slippage. So for a thin edge strategy, or a strategy that trades in a less liquid market, this can significantly erode your edge in your live results unless you model it in your backtest. So you need to take that into account because slippage is very real and it will totally erode your strategy if you're not careful. Your probability, this is a platform to platform metric. Every platform will calculate a little bit differently. It's just an estimate that the chances are not just random. So the platforms calculate this differently and it's often just shown as 0. Trade excursion metrics. So you have your average MAE or your maximum adverse excursion. On average, how far did your trades go underwater before they closed? So this can be used as a stop placement guide. If the average trade dips, $150 against you before working out, a $100 stop loss chops off a lot of your winners, or your eventual winners, before they could have actually gotten to take profit. MAE tells you how much room your winners actually need to run. Your average MFE is your average max favorable excursion. So on average, how far in profit did your trades go up before closing? So this can be used as a TP target or a trailing stop guide. So it's how much profit was on the table at the trade's high watermark. Your average ETD, or average end trade drawdown, is how much open profit the strategy gives from its MFE before it exits. So for example, in our strategy, let's say we have an average MFE of 250 and an average ETD of 200. So it would be average MFE minus average ETD equals average trade. So 200 minus our 250 equals 50, which we know is our average trade. The profit of this strategy is just a small sliver of what the MFE holds on to, signaling that we should probably focus on optimizing the strategy's exits to increase our profit factor and increase our max profit. Some other trading metrics to take into account are expectancy. So dollar expectancy equals the average trade, but a more powerful way to do this is to put it into R's, where 1 R is the amount risk per trade, in our example is 100, then the expectancy is 0.5 R. Every trade returns half of what it risks. This allows you to compare different strategies on a unified scale regardless of target sizing. So it doesn't matter if you're using $100 stops or $500 stops or anything like that, because they're all 1R, and then you can just take the ratio of the R to compare them to each other. So your MAR or CalMAR ratio, so this is an annualized return divided by max drawdown. So above 0.5 is decent and above 1.0 is strong. So your CAGR, or your annualized returns, percent returns, this metric needs a defined account size to work. So in some backtests you can use a defined account size, in some you can't, so you need to take that into account. Your percent return is just the net profit divided by the starting capital. So it's what's your starting capital and how much did you end with. The percentage between there is your percent return, and then the CAGR annualizes that return. And then your risk of ruin, so that's the probability of losing enough to blow your entire account. So you will also need a starting capital, a certain amount of starting capital. And if you blow the whole thing, then you have ruined it. And you can have a great edge, but if you end up taking too much risk, it doesn't matter that your edge is great, because once the account hits 0, you're not taking any trades anymore. So you need to make sure that even though your edge is great, or you think that you're really onto a good strategy, that you don't have a very high risk of ruin. And then finally, we have our standard deviation of trade P&Ls. So it's how many individual results scatter around the $50 average. So two strategies with identical expectancy, but different variance are not equal, right? So if we have our 50% on the line, our standard deviation of trade P&Ls, right, we could have some that are super wavy, we can have some that are super straight, even though they have the same average. So that concludes it. So that's pretty much the whole report, and the takeaway is simple. The net profit is just the headline number, right? But you shouldn't be getting excited over that without taking your other metrics into account. Once you know what to actually look at, like your average trade, the drawdown, how much it gives back, everything else that we talked about today, now you can read any strategy report in about 30 seconds and know whether it's worth your time, and hopefully not get fooled by a pretty equity curve. And then speaking of pretty equity curves, that's the real difficult part here. So everything that we talked about today assumes that we had perfect data, and that our strategy was actually telling us the truth and the data was telling us the truth, and it wasn't just curve fit data. because a strategy can be tuned to look really great on exact data it was built on because that's what you're optimizing on. But then as soon as you put it into a live market, it falls apart and then you actually lose your money. So that's called curve fitting or data fitting or overfitting. And there's a way to stress test for it before you ever risk a dollar, and that's called a Monte Carlo. So that's just running your strategy through thousands of different simulations, as well as you can run it on out of sample test. So in the next video, we'll go over all of that. I'll make a strategy that is super curve fit and looks fantastic, and then we'll end up stress testing it with a Monte Carlo simulation, as well as testing out a sample to see what we could maybe expect out of it live. If this video helped you, I just ask that you subscribe, and if you want to see the next videos, those will be out next week, so they'll pop up in your feed. And leaving a like would help a lot. It helps with the algorithm. I appreciate you all watching, and thank you.